Cool. All right, let's get started.
All right, so me, Marlon, and Kai had mini case four. So the first set of questions had to deal with timelines. So basically, it wanted you to make a $100 lump sum cash flow at the end of year two. Um, so that's the timeline I made for it. Um, yeah. And then the next timeline I had you make was ordinary annuity of $100 per year for 3 years. So this is what that one looks like. And then the final timeline I had you make was an uneven cash flow stream of -50, $100, 75, and $50. And this is what that one looks like. So the next question, what's the future value of an initial $100 after 3 years if it is invested in an account paying 10% annual interest? So for this problem, we have to use the future value formula. I found all these formulas in the book. Um, like when you go on the ebook, there's like a section of the formulas that are used in each chapter. So it has future value equals present value times 1 plus r to the square root of t. Um, and then I have what each value stands for. And then I plug them into the formula. So you can see with the bullet points. And I got the future value to be $133.10. The next question, what's the present value of $100 to be received in 3 years if the appropriate interest rate is 10%? I think that this is the same formula, but I showed what each value means again and then plugged into the formula, and I got $75.13. The next question, so it was, we sometimes need to find out how long it will take a sum of money or something else, such as earnings, population, or prices, to grow to be some specified amount. For example, if a company's sales are growing at a rate of 20% per year, how long will it take sales to double? So I use the compound growth formula, which is I showed here. Um, and since we want the future value to be twice the present value, 2 would equal to 1 plus r to the square root of t. So you would take the natural log or ln on both sides of that equation. And then on the right side here, I solved for t when r is equal to 0.2, which is a 20% growth rate. So then I plugged those two numbers into the formula and then ran it on my calculator, and it approximately came out to about 3.8. So I said it'll take about 3.8 years for sales to double. I'm sorry if you can hear my dog barking. Um, but the next question is, if you want an investment to double in 3 years, what interest rate must it earn? So again, I use a future value formula, and since the investment needs to double, future value is equal to 2 times present value, and the time is t equals 3 years, as I showed in the formula there at the bottom left. So the first step is just to isolate r, and to do that, you have to take the cube root or raise both sides of the power of 1/3. Um, and I worked through the steps there, as you can see in the bullet points. And then the second step is just to solve for r. And yeah, the investment must earn approximately 25.99% annual interest to double in 3 years. The next question was, what's the difference between an ordinary annuity and an annuity due? So an ordinary annuity is when payments occur at the end of each period. And an example would be like a loan payment or a bond coupon. Future value and present value calculations assume cash flows are discounted or compounded from the end of each period. And an annuity due is just when payments occur at the beginning of each period. So like a rent payment or a lease agreement. And future value and present value are calculated assuming cash flows occur immediately at the start of each period. So then I think Oh, this isn't my last question. So what type of annuity is shown below? So basically this timeline displays cash flows of $100 at years 1, 2, and 3. And since the payments start at year 1, the end of the first year, this represents an ordinary annuity. And then like the second part of that question was, how would you change the timeline to show the other type of annuity? And to convert this to an annuity due, you would shift each payment one period earlier. So the first payment moves to year 0, the beginning of the first year. And the second payment moves to year 1, and the third payment moves to year 2. So the new timeline for an annuity due would show $100 at years 0, 1, and 2 instead of $100 at years 1, 2, and 3. So this question was, what's the future value of a 3-year ordinary annuity of $100 if the appropriate interest rate is 10%? So this one's a different formula than we've used so far. It was the future value of ordinary annuity or FVA formula. And I put that there. And then I showed underneath where it says where, what each value represents with the numbers that they gave us. And I plugged it into the formula and I got $331. The next question is, what's the present value of the annuity? So you use the present value of an ordinary annuity, which is another new formula, which I showed here, and then you plug in the same numbers. And the present value of the ordinary annuity, I got $248.69. The next question, what would the future and present values be if the annuity were an annuity due? So for an annuity due, payments are made at the beginning of each period. To convert the results, you just multiply by 1 plus R. Um, so for the future value of annuity due, I have the formula there, and you just use the figure that I found a couple slides ago, and then plug in or multiply it by 1 plus R, and R is 0.1 in this case. So the future value of the annuity due is $364.10. And then you do the same thing for present value of annuity due. I just use the value that I found on the previous slide and multiplied it by 1.1. So I got the present value of the annuity due to be approximately $273.56.
So for my first question, it says, what is the present value of the following uneven cash flow stream? The approximate interest rate is 10% compounded annually. So this is the same formula that AJ used earlier, but instead of T, I used N, which is basically the same thing. So I won't explain the formula. But I basically got the present value for each year, summed it up, and then it gave me a total present value of $530.05. So next, define the nominal rate, which is also called the stated rate, and the quoted rate. Also define the periodic rate. If the nominal rate is 6% and is compounded quarterly, what is the periodic rate if it is compounded monthly? So the nominal rate is the stated annual interest rate on an annual basis without considering the effect of compounding within the year. The periodic rate is the interest rate charged or earned for each compounded period, such as monthly, quarterly, or semi-annually. Um, and periodic rate equals nominal rate divided by the number of compounded periods per year. So for the first periodic rate, which is quarterly, I took the 6% and then divided it by 4, which gave me 1.5% per quarter. And then for monthly, 6% divided by 12, which gave me 0.5% per month. If the stated interest rate is constant, will the future value be larger or smaller if we compound an initial amount more often than annually? Why? So we said the future value will be larger just because the interest earned is added to the principal for more frequently, which leads to faster growth. And then if interest is compounded annually, the interest is only calculated and added once a year. And then lastly, if it is compounded semi-annually, the interest is calculated and added twice a year. So the principal grows more frequently and this accumulates more interest over time. And then you'll see that in, I believe, the next two problems. So what is the future value of $100 after 5 years under 12% annual compounding, semi-annual compounding, quarterly, monthly, and daily compounding? So again, same formula. I believe we just multiply n by t, which is n is the number of compounded periods per year, and then t is the number of years, which is 5. Um, so for annual compounding, came up with 176.23, then semi-annual 179.08, quarterly 180.61, monthly 181.67, and then daily 182.19. Then for the next one, what is the effective annual rate, also called the annual equivalent rate? What is the EFF percent for a nominal rate of 12% compounded semi-annually, quarterly, monthly, and daily? So the effective annual rate is the interest rate on an investment or loan that is compounded more frequently than once a year. It represents the interest earned or paid over a year, accounting for the effects of compounding. So this is the formula I used. 1 plus r divided by n over n minus, to the power of n minus 1, which r is the nominal interest rate, and then n is the number of compounded periods per year. So compounded semi-annually came up with 12.36% quarterly, 12.55% monthly, 12.68%, and then daily 12.75%. Can the effective annual rate ever be equal to the nominal rate? So say yes, just because the effective annual rate, but we said only when the compounded period is annual, which means the interest is calculated and added to the principal once a year. Then for my last question, explain when you should use a nominal rate, periodic rate, effective annual rate, and annual percentage rate. Can you think of a way to modify APR so that it would be more helpful? If so, how would you calculate that rate? So for all four, nominal rate will be used for simple comparisons when compounding isn't a major concern. Periodic rate will be used when you're calculating interest on a per period basis. Effective annual rate should be used when comparing financial products with different compounded frequencies, and the APR should be used when comparing loans and credit products, especially with additional fees or charges. And then APR currently doesn't reflect the true cost of borrowing because it assumes simple interest and doesn't account for frequent compounding or fees over time. So to improve its accuracy, APR could be modified to include effective compounding and additional fees, offering a clear picture of the total financial burden. So here's our modified APR formula where I is the nominal interest rate, N is the number of periods per year. The total fees is basically just the sum of all fees associated like with the loan or credit, and then the principal is the amount borrowed.
Sorry. Oh, so for the next question, it was, suppose that on January 1, you deposit $100 in an account that pays a nominal or quoted interest rate of 11% with interest added daily. How much will you have in your account October 1 or 9 months later? So from there, you just plug in the formula, and I'll use the compound interest formula where A is the amount in the account after interest, and then the PPP, well, the P is the principal, which is $100, and then R is the annual nominal interest rate of 11% or 0.11 as a decimal. And then N is the number of times the interest is compounded per year. So that's 365. And then T is the time in years. So you just convert that to days by divided 273 by 365. And then you get A equals 100 times you do the math, and then you get $108.96. Sorry. The next one was, consider the timeline shown here is the stream of cash flows and annuity. And it's basically showing that you get $100 at the end of each year. And that basically is the definition of an annuity. So yes. Next question was, what is the value at the end of year 3 of the previous cash flow stream if the quoted interest rate is 10% compounded semi-annually? So you use the future value formula, which AJ and Kai both explained. So step one, you just calculate the future value in year one, and that's the FV1, and you get 121.55, and then you do the same thing for year two, and I got 110, and then you basically combine those plus the flat rate of 100 for year three, you get the total of 331.80 cents. So next one is, what is the PV of the same stream? So now you're calculating the present value, and you use the present value formula, and you calculate the present value for year one, which is PV1, and you get 90.70. Do the same thing for PV2 and PV3, and then you add them all together for the PV total of 247.61.
Hey, Marlon,
Yes.
I just have one question. Go back to that screen. Yeah. And you're right with everything, but I just want to point out, why is year one 90.7 as opposed to 100?
It's a great question. I mean, you're asking like
So
basically.
the problem is every now and then we get this wrapped up into math and we don't think what does that actually mean. So that's what I'm just pushing for here. And
Yeah.
I'll give you the answer because of the this is a regular annuity. We don't get that $100 till the end of the first year. And so we're doing the present value as of year zero. So that's 1 year in the future. So obviously it's worth less than $100 today.
Okay. Thank you.
Yeah, just thought I'd jump in and cause problems.
Okay, so the next question, it basically started out with this, and then it went into like three separate parts. So the main part of the question was, you have a chance to buy a guaranteed promissory note for $850. The note pays $1,000 in 15 months, which is exactly 456 days. You have $850 in a bank account that pays a 7% nominal rate compounded daily. Which is a better investment, the note or the bank account? And then we basically went into three different approaches to answer this question. And the first one was to compare your future value if you buy the note versus leaving your money in the bank. So the future value of the note is obviously $1,000. And basically we have to find the future value of the money in the bank. So you take the initial deposit of $850 with the nominal rate of 7% per year compounded daily over 456 days. And you plug that into the future value formula and you get $926.76. So the conclusion from this approach was the promissory notes provides a future value of $1,000 while the bank account would only yield $926.76. So the promissory note would be a better investment given the higher future value. The next one was to compare the present value of the note with your current bank balance. So you calculate the present value of the promissory note with the formula with the future value being $1,000 and R being the 7% and N being the 365 days, and then T would be the days and years. And basically from this approach, we got that the present value would be $917.43. And the conclusion from this approach was that the present value of the promissory note was $917.43, which is higher than current bank balance. So the promissory note is the better investment because its present value is greater than the amount that you currently have in the bank. And the last one was to compare the effective rate of return on the note with that of the bank account. So the effective rate of return on the promissory note, use the formula at the top, and where the future value is 1,000, the present value is 850, and T would be the time, and you divide the 456 days by 365 days to get the time in years. And you basically plug that into that formula and you get 13.35% on the promissory note versus the 7.25% of the bank account. And then the next one, you had to calculate the effective annual rate of return on the bank account. So use the effective annual rate formula where the R nominal is the 7% interest, and then N will be the 365 days, the number of compounding periods per year, so it's daily. And you plug in those numbers and you get the 7.25%. And the conclusion from this one was the promissory note offers a higher effective rate of return of 13.35% compared to the 7.25% of the bank. Therefore, the promissory note is a better investment in terms of effective rate of return. And that's all we have.
It was a lot, wasn't it?
Yeah.
Yes, yes, it was. Yes, yes.
That's why there were three of you. All right, that's good. Good work, guys. I'm happy with that. So I guess it's time for me to start working on chapter 4 with you guys. So see, I think Marlon, you still have, or do I have the ability to share my screen at this point? You may need to give me back power.
I just made you the host again.
All right, then we're in good shape. It says I am the host now. Great. All right, so set to default share. All right, so let's just go into chapter 4 and pick up what we have going on there. I am sharing my screen with you, and I have my screen broken up into two different pages. The page on the right is the book. The page on the left is from the I guess it's a workbook that they make available to us from the publisher. So I do like it, and as we move forward through the chapter, it will become obvious as to why I like that. All right, so let's start talking about. So this chapter is future value and present value and all that good stuff, and the basis of that is the timeline. And I guess the only thing that's important that you have to realize when putting a timeline together is it starts at 0. It doesn't start at 1, it starts at 0. So that question that I had asked Marlon as to why his year 1 was $90 as opposed to 100, it was because the payment didn't occur until the end of that first year. So we were standing at 0 on the timeline, and we were looking at a $100 payment that was coming to us 1 year in the future. The one thing that the book likes to point out is when you get to that tick mark on the timeline there, it tells you two things, actually. It's the end of the first year, but it's also the exact beginning of the second year. So that does show that if we were standing at 0, a payment of $100 at 1 is a year in the future. So it did need to have its value reduced to come up with a present value. So that's what the text is talking about. All right, future values is the opposite of present values. Generally, the future values are going to be a little bigger than the present value because we're taking into account the fact that we are going to have some sort of return, even if it's just that we're calculating what inflation is going to do to money or whatnot. But when we take present values into future values, what we're doing is we are basically compounding the investment or the interest on this. And we have a little key here of the variables or the that they use in here. PV is present value. FVN is future value or ending amount after the end periods. CFT is cash flow, can be positive or negative. Whoops, where'd I go there? I is the interest rate earned per year. Sometimes lowercase I is used. INT, dollars of interest, so not the rate. The capital I or small I is the percentage, where INT is the actual dollars that we're talking about, and N is the number of periods. Now, as we go through the chapter here and start doing all of the calculations to come up with all of these various, wonderful numbers that we're going to come up with, they're going to give us a few different ways of doing it. Most specifically, they're going to give us the ability to do it with a formula. They're going to give us the ability to do it with a financial calculator, and they're going to give us the ability to do it with an Excel spreadsheet. I'll be very honest with you. I prefer using the Excel spreadsheet. If you guys want to do the formulas, the few times that I've taught this course, I will occasionally get an actuary major in the class, and they absolutely love doing the math. And more power to you if that's what you want. I'll be honest with you, and I think I've pointed this out in the past. I would rather take the path of least resistance, and in my mind, it's the spreadsheet, because it's something that you can create and you can leave your calculations on the spreadsheet. You can come back and reuse the formula over and over just by changing the variables. Can't necessarily do that easily on a financial calculator. So I prefer the spreadsheet for this purpose, and as a result, we'll acknowledge that the other possibilities exist, but we're going to end up using the spreadsheet, which is what the left-hand portion of my screen is. That is the spreadsheet master that the publisher has provided. I do believe you have access to it in the electronic version of the book. It's what's it called? It's called CH04 Toolkit, and you'll see it. I'll point it out when we see it in the chapter. You guys can click on it and have access to it directly also. All right, so step-by-step approach for coming up with a, I guess we're doing future value here. So if we have, you start with $100 in the account, we multiply the initial amount and each succeeding beginning of each year by 1 plus I, so 1.05. So you earn 100 times 0.5, $5 of interest in the first year. We start the second year not with 100, but with 105. So instead of earning another $5 worth of interest, we earn $5.25 because we're earning on the interest that has been added to the principal. And that happens over and over and over again. So compounding is basically the concept or the idea of getting interest on your interest. Okay, so we don't just say, oh, we had $100, and if we had left it in there for 10 years, it's going to be 5% 10 times, so we're going to get $50. No, but we have to take into account that we're getting interest on our interest, and that's what is compounding. All right. And I have no idea how true this is, but there is a belief that there's a quote from Albert Einstein out there saying that the strongest force in the universe is compound interest. I don't know if that's true or not. It sounds pretty interesting, but all right. So 4.4-2B in the textbook, we have the formula approach. So you can take a look at the formula here and you can create this. So this was for 2 periods. So at the end of period 2, we would have ended up with the 110.25, which would have been $5 for the first year and $5.25 for the second year. And the formula will work just fine. Here's how you do it on your financial calculator. Here's the buttons that you would need to push. It just sort of pains me to think that I would be trying to do this course by teaching you how to use your financial calculator. But if you choose to do your calculations using a financial calculator, here's the buttons that you would need to push. If you want, you can go out to any store in the electronics department and buy a financial calculator. I do know that I had the ability once to download a financial calculator at no charge on my cell phone. So it came up as an app. And I did actually do these things to make sure that they worked, and they do, and the app worked just fine. But I'm not interested in teaching you guys how to use your calculator. Spreadsheets. I am interested in teaching you how to use your spreadsheets, though, Excel. So here we are at the beginning of the spreadsheet section here. Now I'm using the 16th edition because that's where I have all of my notes. I do know that hyperlink there does exist in the 17th edition, which is the one that you guys have access to. So that's it right there, Chapter 4 Toolkit for Excel. And all of the calculations that we're going to be doing are going to be over here in this Chapter 4 Time Value of Money Toolkit. Okay, so I find it very, very useful, to be honest with you, because realistically, when you're looking at how they're doing these things, if you just click on the cell, you can go up and you can see what the actual formula was that got them to that particular result, the answer. So I do like the toolkit. So it is a tool that I do tend to use. All right. Anyhow, alternative procedures for calculating future values. So they actually have the same thing reproduced in both places here. Over in the toolkit and over in the textbook, it's the exact same thing. Yeah, I don't have the ability to click on a cell here. I guess I can click out of that. But I do have the ability to do that over here in the toolkit. Just as a thought here, the toolkit actually does run wider than the window that I have displayed. But this is something that will become important in later chapters, and I'll have them available then. So let's take a look over at figure 4-1, calculating future values. One of the things that they like to do is they do like to make a little table out of the variables that they're using. So the investment, in this case, is $100. And basically, for our purposes in the spreadsheet, it needs to be put in as a negative number because it's not money coming to you, it is your investment. So it's actually money that you are expending. I is going to be the percentage of the interest rate. So in this case, they're using 5%. And there's a number of periods so it's going to be 3. So 3 periods here. Timeline shows here 0, 1, 2, 3. This is not an annuity. It's not happening every year. We're putting the money in at 0, right? The beginning of year 1. So we're going to have 1 full year of interest, 2nd full year of interest, 3rd full year of interest. And then we're going to have the money here at the beginning of period 3. So here's their step-by-step. There's their formula. There's the financial calculator. Let's go to the spreadsheet now. Okay, so the FV function is what we're looking for, the future value. Now, what I want to do is create a blank spreadsheet. I'm just going to open up a new blank spreadsheet. I'm going to drag it over here just to have it available. Now, where do you find these particular functions? Okay. I should have looked that up before I came here. No. Where was it? Back to home. Yeah, wouldn't you know, I put myself into a hole. Let me just look it up real quick. Now it's showing me what they are. under the formulas tab. So come over here, formulas. Especially the financial function group. Okay. Formulas. Financial. All right, so here's all of the financial formulas that you can use. This one was future value. It's right here, FV. So all you would do is you would highlight it, come over under formulas, go to financial, go to FV, and it's going to tell you what you're going to need in order to make this function work. Okay, so if you want to click, let me do this way. All right, I'll just make sure I have a cell. So FV, and now what it's going to do, it's going to ask me for the various things that I need. Okay, so the rate we know is what, 5%? So that's going to be 0.05. The number of periods is going to be 3. The payment, we're not making payments. There's not going to be, this is not an annuity, so we don't have money coming and going. We do have the present value, right, of the $100, but that's a negative $100. And type. Now, on type, if we're doing annuities, there's going to be either a 0 or a 1 under type. Now, if it's a normal annuity, it will be a 0, but you can ignore that. You don't have to put the 0 in. If it's an annuity due, which remember means the annuity is paid at the beginning of the period instead of the end of the period, then you would have to put a 1 in there. So this is not going to be a 1, so we can just leave it blank for the moment. If we hit this here, I just hit, calculate. So $115.76 is exactly how it got calculated on all three, step by step, multiply every step out, use the formula, or to use the financial calculator, or to use the Excel spreadsheet. So I find that to be extraordinarily easy. I like it. I like using the Excel spreadsheet a lot. Just remember, formulas, financial, and everything that we're going to be talking about, they're all going to be here. And the reality of it is they're going to give you the instructions on what you need to do. They're plain old going to give you a chart to fill in anyhow. So I really like this. And it makes everything we're doing significantly easier than going through and doing all of the calculations. I am certainly one of those people that believes that, we have developed tools to make our lives easier. I'm not going to sit here and say you need to learn the archaic ways of doing these things when we all have the tools, we all have the computers directly in front of us, and we all have Excel as part of our operating system. Why not use it? It's just so much easier. So I really love it. And I think it makes everything we're going to be doing in this class significantly easier. So it doesn't make me a bad guy in saying all I'm going to be doing this semester is teaching you how to use the financial functions in Excel. Maybe I'm a bad guy or not, but it's going to get you to where you need to be. Why should you have a harder way of getting there? There's no reason to. Okay, so future value of $100 at 5% 3 years from now is $115.76. So we knew that we were going to have 110.25. So basically that third year, the compound interest got us an additional, what, $5.51. So it goes up every year. It just calculated it for us. All right, so Okay. illustrates Excel's function values. When the function value is 48 shows how the function with those inputs. Finally, cell 49 shows how the formula will work. Generally, we use cell references as function inputs. This makes it easier to change inputs and see how those changes affect the output. Sensitivity analysis, which is another one of the reasons that I really like using Excel to do this, because later on, what we're actually going to be doing is we're going to end up making charts of the variables that we're using, and we'll end up just changing the numbers in the charts to see how that will change our result. Is it, do we have the result that we're looking for if we change the interest rate from 5% to 7%, or what happens if we end up at 3%? It gives us the ability to very easily do a lot of what if scenarios. So I'm a big fan. If students are confused about the sign of the initial 100, we use 100 in rows 39 and 41 as the initial investment when calculating for future value using step-by-step method and the future value formula. But we now use a negative 100 with the financial calculator and the spreadsheet. When you must use a positive value, you must use a negative number. The answer is that whenever you set up a timeline, use either a financial calculator timeline function or Excel, you must enter the signs that correspond to the direction of the cash flow. Cash flows that go out of your pocket, outflows, are negative, but cash flows that come into your pocket, inflows, are positive. In the case of the future value function in our example, if you invest the $100, it's an outflow, thus a negative number at time 0. Then the bank will make available to you 115.76, an inflow, and they're positive at time 3. So there's where we end up. All right, moving forward. Comparing the procedures, spreadsheets have 2 additional advantages over calculators. It's easier to check the inputs with the spreadsheet because they're visible. With calculator, the inputs are buried somewhere in the machine. Second, with a spreadsheet, you can make your analysis much more transparent than when using a calculator. Graphs, a graphic view of the compounding process. So what we have here, and I believe we have it here also in our toolkit. And basically what we have here see if it, yeah. We end up looking at what 1, 2, 3, 4, 5 different values for on a chart for the value of our $100, the future value of our $100. And they're taking it out to basically 10 years here. They start with a negative 20%. So instead of getting a positive return, we're actually losing 20% of our value every year. As you can see, that we're approaching 0, but it never goes to 0. Okay, that's because we're not using hard numbers here. We're using percentages. So you're losing 20% of something. There's always going to be some residual left. So you can see that this blue line here ends up going down and approaching 0, but it'll never actually hit 0. The next number that they use is a 0% return, which is a horizontal line directly at the 100%. We get nothing for it. This is if you buried it and you put it under your mattress, and at the end of 10 years, you took it out from under your mattress, you still have $100. 5%, you can see we have some growth, comes above the 0% line. 10%, you can see that we have it going above that. 20%, we can see a curve that's going up quite dramatically better than any of the others, which is what you would expect, right? You would expect to see significantly better return than 10% because that's twice the value. So you can take a look at those. That's just a graphic representation of what we just did. All right, simple interest versus compound interest. When interest is earned in prior periods, we call it compound interest. If it's only on the principal, it is simple interest or called regular interest. So if it was not compounding, then you would end up getting $5 every year. So at the end of 3 years, you would have $115. Okay. I don't know where in the world you could go to do that and get no compounding, but I guess that's a possibility. Interesting. Ben Franklin wanted to make a donation to Boston and Philadelphia, the two cities that were important. He was born in Boston, but made his fortune and whatnot in Philadelphia. He didn't want the cities to squander the money, but he wanted it to make a big impact. His solution was what was called the Methuselah Trust. When he died in 1790, he left £1,000 at the time, about 45.50, to Philadelphia and to Boston. But the condition would be that it would be invested for 100 years, after which some of the proceeds would be used for public projects, trade schools, and waterworks, and the rest invested for another 100 years. Depending on interest rates, the strategy could generate quite a bit of money. For example, if half of his bequest, $22.75, remained invested at 5% compound interest for 200 years, the value in 1990 would have been $39.3 million. The ultimate payout was only about $7 million because substantial amounts were eaten up by trustee fees, taxes, and legal battles. So Franklin would have been disappointed. All right, present value. You have extra money, you want to make an investment, a broker offers to sell you a bond that will pay guaranteed $115.76 in 3 years. Banks are currently offering a guaranteed 5% interest on 3-year certificates of deposit. And if you don't buy the bond, you will buy a CD. The 5% rate paid on the CD is defined as your opportunity cost, or the rate of return that you would earn on an alternative investment of similar risk if you didn't invest in the original security. So discounting a future value to find the present value. Why is this important? Let me ask you guys this. Why is it important that we be able to find the present value of a number in the future? Well, in the mini case, I can't remember which of the three of you was doing it. It might have been Marlon, where you were told to do the analysis of whether you were going to buy the $1,000 promissory note or whether you were going to just invest your $850 in the bank, and you were asked to look at that 3 different ways. And one of the things that you did was you calculated the present value. Okay, right now at 0.0, you had $850 in your bank account, and I can't remember how many years it was in the future that was going to be $1,000 that you would get from that promissory note. So when you converted that $1,000 that was in the future to present value, it gave you the ability, excuse me, to compare it to the money that you had now. It's impossible without doing the calculation to know which is better, the $850 you have now or the $1,000 in the future. Okay. Do you want to sit on the $850 because you believe that it's worth more money? Or do you want to buy that $1,000 promissory note that's going to pay off some number of years in the future? And if you remember from the mini case, when you did that calculation, I believe the promissory note ended up being having a present value of like $917 or something like that. Well, that $917 was greater than the $850 that you had in your bank account. So it was worth more money. Okay. You have to be able to look at money from different time periods in the same time period. So the other one of the choices was to take your $850 and create a future value for it and then compare that to the $1,000 future value. So there are a number of ways of doing this. If I remember, the third way was to do the effective rate of return. But this is one of the things. If we want to be able to look at money in the future and we want to know whether it's worth making that investment now, we have to be able to convert that future amount into a present number, present value, so that we can compare it to other choices. Okay, so let's say that you had 4 different choices, each with different payouts at different numbers of years in the future. You wouldn't know which is the better investment unless you did this calculation to bring it all back to present value. And then whichever had the highest present value, that would be the investment that would have the best return. Okay, now the book's a little bit lazy here because they're using this $115.76. And if I go back up here, you see that that's the value that we calculated that you would have compounding your interest on $100 at 5%. So we know what's going to happen when we do the present value calculation of this $115.76 3 years in the future at 5%. Okay. You could buy the bond for this for less than $100. You should buy it rather than invest in the CD. $100 is defined as the present value, or PV, of $115.76 due in 3 years when the appropriate interest rate is 5%. In general, the present value of the cash flow due N years in the future is the amount that, if it were on hand today, would grow to equal the given future amount. So if we take $100, put it into an investment that's going to give us 5% compounded annually for 3 years, it would be $115.76. Finding present value is called discounting. As you can see, it is the reverse of compounding. All right, alternative procedure for calculating present value. All right, so I have the right thing up on the toolkit here. So future payment is $115.76. That's the future value. The interest rate we know of is 5%. We know our number of periods is 3. So you can go through the timeline if you like. You can go through the step-by-step. You can go through the formula. You can go through the financial calculator. What am I going to say? I want to do the Excel spreadsheet. And I want to bring up my blank Excel spreadsheet because we're going to do it. All right. So I'm going to go back over here to my financial, and we know that we're looking for present value, and this is all going to be in alphabetical order. There's my present value, PV. It gives me my input chart. So the rate, once again, is going to be 0.05. The number of periods is going to be 3. No, once again, we don't have any payments. This is not an annuity, so we can use this same function. If we have annuities, we'll just end up with numbers in here. The future value we know is 115.76. Type, once again, if it was an annuity due, we'd put a 1 in there. We're not going to put anything in there because that's not what this is. We hit OK. $15.76. What did I do wrong? I did something wrong. Oh, I didn't eliminate everything else that was in there. Let's get rid of everything. Do it again. Let's do the present value. Rate 0.05. Number of periods 3. Payment none. Future value is 115.76. We don't do the type. Hit OK. There's $100, and once again, it should come up as a negative $100 because that's what we would be out of pocket if we were to try and create that 115.76 in the future. So once again, I believe this is an extremely easy way to do this. I probably should have done that not over the top of it so we'd have both of them sitting together. Here's your financial calculator if you are so inclined. Present value function for Excel, financial calculator, answer the question, how much must I invest today in order to have available to me a certain amount of money in the future? Graphing again, so we can do some graphing to show the present value of a sum to receive at a future decreases and approaches 0 as the payment date is extended further and further into the future. So once again, we have the same chart over here in the toolkit. If we had $100,000 and we're looking at 40 years in the future, if we have a 0% rate of return, then that $100,000 is a horizontal line on our chart. So if we look at the future value, present value. Why does it say future value? Present value of $100 at various interest rates and time frames. So we have it's $100. It's not 100,000, but at 5%, we see it dropping down over here to $20. Present value. And as you can see, as the rate of return changes, the graph will get steeper and steeper. This one here was, I guess, 20%. You see that it goes very steep. But once again, we can't go all the way to zero. It just approaches zero. Same thing out here at 10%. As we get further and further in the future, the value of that future value goes down because of the time value of money. All right, so the next thing I want us to do in the book here is to find the interest rate. So the equations had 4 variables. If we know 3 of them, then we can calculate the 4th one, or at least the financial calculator or Excel can do it for us. So if we know the present value, if we know the interest rate, and we know the number of periods, we can solve for future value. Or if we know future value, interest rate, and number of periods, we can solve for present value. Suppose we know present value, future value, and number of periods, and we want to find the interest rate. How do we do that? Well, here's our financial calculator for those of you that are inclined to want to do that. Finding the interest rate over here. The rate function can be used. All right, so let's see, what do we have as far as our information? We have a present value of 100, we have a future value of 150, and we know the number of years. So we're looking for the rate. All right, bring up my blank Excel spreadsheet, pick a cell, and let's look for rate. Right here, rate. You hit it, we're going to get our input chart, number of periods. Number of years is 10. Payment. Once again, we're not making payments. This is not an annuity. Present value, we know, is $100. Future value, present value is a negative $100 because we would have to actually expend that $100. Future value is going to be $150. Once again, type we're not going to use because this is not an annuity. Hit OK. 4%. So changing the number of decimal places will give you that. 4.14. We got what the book got. So obviously we did the right thing. All right. So taking this down, moving on. That was finding the rate. How about if we need to find the number of years? There's your financial calculator if you're a fan. Finding the number of years. So NPER, the number of periods, is what we're looking for here. Go back to my Excel spreadsheet, pick a cell, financial, NPER, right here, number of periods. Rate, we know it's 4.5%, 0.045. Payment is a negative 500. No, that's not payment. Payment would be if it's an annuity. We're not. It's the present value. Sorry, I got myself confused. Negative $500. The future value is, that was 500,000. The future value is $1 million. Once again, we don't need type because this is not an annuity due. Hitting OK. 15.7473. Got it. So at 4.5%, basically we're trying to double our money here, right? So the present value would have been an investment of 500,000. And how many periods is it going to take us to double our money? Well, 15.74. That was also, if you remember, one of the problems that was in the mini case. How many periods was it going to take to double your money? But I believe you had a interest rate of 20%, which made it more, well, that made them a much smaller period. This, that being at 4.5%, you would need 15, almost 15 and 3/4 years in order to double your money. Perpetuities. Now, here's your problem. Some things don't have an end. Some things theoretically go on forever. So we're talking about perpetuities. If you were to buy a corporate bond, you would be receiving, let's say it's a 5% bond. You had to pay $10,000 to get it. So you paid $10,000, you're going to get 5% back per year. What's that going to be? $50 per year in interest. But basically, it's going to be a 10-year bond, which means at the end of 10 years, you get your last interest payment and you get your $10,000 back. You don't have to calculate the value beyond that because it stops after year 10. Well, what if we had purchased some shares of stock in the company instead of a bond? Now, one of the things that you tend to receive if you invest in a good company that is run well and has ongoing profits is the ability to collect dividends. So that groupings of payments coming from the company as dividends could look a little bit like an annuity, or it could just look like various types of streams of income, may not be exactly the same amount. But when does it end? Well, the way that we create corporations, they don't have an end date. In theory, corporations will go on forever. So this is a perpetuity problem here, okay? However, look from the book, some types of stocks and bonds pay a fixed amount each period, but don't have an ending date because the payments are perpetual. This pattern of cash flows is called a perpetuity. Okay, so the present value of a perpetuity is the amount of the payment divided by the interest. All right. So suppose we have a payment of $25 for each period, and the interest rate is 2.5%. Using the equation, payment over interest rate is 25 over 0.025. That means the present value is $1,000. Okay, what happens to the present value if interest raises to 3%? Well, then it'd be $25 over 0.03. It'd be $833. What if the interest rate dropped to 2%? Then it would be 25 divided by 0.02. The perpetuity value would be, present value would be $1,250. Important point. When interest rates change, the present value changes inversely to the change in the rate. Thus, the present value declines if the interest rates rise, and the present value will increase if interest rates fall. Okay. And I highlighted here in the self-test, do bond prices move directly or inversely with interest rates? That is, what happens to the value of a bond if interest rates increase or decrease? So you have to look at it from the point of view that you bought a bond, and basically it has a fixed amount of interest that it is going to pay for the term, for the life of that bond. So if you had a 10% bond, a bond that paid 10%, and interest rates went to 11%, the value of the bond is going to go down. So as interest rates go up, the value of the bond goes down. Why? Because the 10% that it's paying is below the market. You could take your money and go someplace else and get 11%. Why would you put why would you put it into this bond so that you could earn only 10%? Well, so that it makes a lot of sense that the value of the bond should go down, because if you do the calculation, whatever the new value of the bond is multiplied by the new interest rate, 11%, will bring you back up to the appropriate return that you could have gotten in the market. . All right, we've been dancing around this, but we haven't been talking about annuities directly. Let's talk about annuities. All right, we've been talking about lump sum payments. Now we want to talk about what happens if we get payments over time. Assets such as bonds provide a finite series of cash inflows over time. Obligations such as auto loans, student loans, and mortgages call for a finite series of payments. If the payments are equal and made at fixed intervals, then we have an annuity. Okay, so that's the rule. The payments are equal and they are made at equal intervals. That's an annuity. All right. So, for example, $100 paid at the end of each of the next 3 years is a 3-year annuity. And I'm going to skip down on the page here to the ordinary annuity. Okay, so they have 5% above the timeline here. So it's going to be a 5% annuity. And our payments are going to be $100 a piece for 3 years. And once again, this is identical to what you saw in the mini case. So an ordinary annuity, we start at period 0, we don't get any money. We get nothing. The $100 doesn't occur until the end of period 1, and then again at the end of period 2, and then again at the end of period 3. So since you have these listed out here as negative numbers, this is an annuity that we are paying. So we have to pay $100 at the end of 1, at the end of 2, and at the end of 3. An annuity due, if we're involved in an annuity due, then we make the payments starting at time frame 0. So we make a $100 payment at 0, at the end of year 1, at the end of year 2. Okay, that's an immediate annuity is what that is. Most of the time, an ordinary annuity, the money will sit for a year before any payments need to be made. Okay, an annuity due or an immediate annuity, the payment is made at point 0. All right, we can find an annuity's future value, present value, the interest rate built into the contract, how long it takes to reach a financial goal using the annuity. And if we know all of these values, we can find the size of the annuity payment. Keep in mind, annuities must have constant payments and a fixed number of periods. If these conditions don't hold, we don't have an annuity. All right, moving along. Future value of an ordinary annuity. Okay, so this is one where we're going to be making the payments $100 in period 1, 2, and 3. Okay, so we don't make a payment at 0. We make it at 1, at 2, and at 3. So what you would do is you could, if in the step-by-step process, this is the future value. So what's the value going to be of each of those $100 payments at the end of year 3? Well, let's do it backwards here. I'm going to follow these arrows. Okay, I guess I can do it over here. It's a little brighter and bigger. If we take a look at the payment at the end of year 3, and we want to know what the future value of that $100 payment is, it's $100 because we're valuing it at the end of period 3. When was that $100 payment made? At the end of period 3. So that doesn't have any valuation change. It's worth $100 3 years in the future. Let's go back one payment and look at the payment number 2, which is made at the end of period 2. Well, what we have to do is we have to change its value because that $100 was made at the end of period 2, but we're valuing it at the end of period 3. So it would end up with a value of $105 because it would have that 5% for 1 year. If we look at the first payment, the one that's made at the end of period 1, at the end of period 1, that $100 actually in period 3 has had 2 adjustments to its value. It has the 5% from year 1 to 2, and then it has another 5% that compounds on the 105. So we have 110.25. You add all three of those together, the 100, the 105, the 110.25, you get a value of $315.25. All right, or we can go to Excel. So Excel is telling us that we can use the future value function. So now we have an annuity. Let's see if we can recreate the answer here. All right, it's telling us we need to use future value. So this is going to be a future value of an annuity. What's our rate? 5%. What's our number of periods? 3. What's our payment? Now, we do have a payment here. It's these 3 $100 payments. It's not $300, it's the $100, and I believe it should go in as a negative number because we're making those payments. Do we have a present value? I don't think so. Do we have a type? Well, this is not an annuity due. This is a regular, ordinary annuity, so we don't bother with it. We could put a 0 in there, but I'm not going to bother. $315.25. So that is how you would do it in Excel. You know, it gets you the same answer. You could go through and do this formula if you like. I guess if you have a financial calculator that you bought at some point in your past, you could do that. You could certainly go up here and recalculate for each of these numbers. Or you could do the easy way and just do it on the Excel spreadsheet. Now, if you look up here in the step-by-step process, this isn't terrible. All we had to do was come up with present values for, or future values for, well, we didn't for the last payment because it was never adjusted. We just had to do these two numbers. So it's not that terrible. Maybe we should do the step-by-step process all the time. What if it was a 20-year annuity? You want to do this 19 times? You could. Nothing that says you can't, but why bother? We can do it down here with the future value formula. By the way, this is just explaining what I talked about when we did the step-by-step. Assume that you're 26 years old, you just received your MBA. After reading the introduction to this chapter, you decide to start investing in the stock market for your retirement. Your goal is to have $1 million when you retire at age 65, assuming you earn 10% annually on your stock investments. How much must you invest at the end of each year in order to reach your goal? Well, the answer is $2,491, but this amount depends critically on the return of your investments. If your return drops to 8%, then the required contributions would go up to $4,185. If, however, the return rose to 12, you could get away with only putting away $1,462 per year. So, obviously, the earlier you start investing, the more money you're going to have at the end. So take a look at it. All right, moving right along. All right, future value of an annuity due. So that becomes this here. So we see the difference here is that we're going to have 3 payments of $100 each, but it's an annuity due, meaning you get the first payment at 0.0. So this is an immediate annuity. You have to start paying this as of day 1, not at the end of the first year, but as of 0.0, then at 0.1, then at 0.2. So each of these needs to be valued for the future value, okay? Where are we valuing these things for our purposes? Right out here at the end of period 3, because that's still where we want to know the value. What's this going to be worth at the end of period 3? Well, we don't have any freebies here. Up here, we didn't have to revalue this third payment because the payment was made at the valuation date. So that $100 became $100. No freebies here. because the last payment was made at the end of period 2, the very beginning of period 3. So there is a whole period here that we have to have an adjustment for. All right. So the third payment is not 100, but it's 105 because it gets that $5. The second payment, which is made at the end of year 1, ends up with 2 years worth of adjustment. We saw that before. The first $5 in interest and then the $5.25. So that's worth 110.25. The first payment has 1, 2, 3 periods that it will be adjusted for. So it's worth 115.76. The total future value is $331.01. Let's take a look at the Excel spreadsheet once again. Future value. Financial. Future value. Rate, 5%. Number of periods, 3. Payment, that's the negative $100. We don't have a present value. Type, since we have an annuity and this is an annuity due, we have to put a 1 in here to tell Excel that everything moves forward by 1 time period. Hit OK. Instead of it being $315.25, by having that additional period in there, it's now worth $331.01, which is exactly what the book said that we should have gotten. All right, moving right along. Everybody asleep now? Somebody tell me you're awake.
Not yet.
All right.
I'm
Appreciate it.
awake.
All right. I just
I'm awake.
We up, Professor. We up. We up.
I'm awake as well.
every now and then I'm going to ask, okay? All right. So that was the future value of an annuity due. Let's keep moving. Present value of an ordinary annuity and annuities due. So 4-10 is going to be same thing over here, moving forward. Summary of present value of an ordinary annuity. Okay, so we don't want the future value anymore. We want the current value. So $100 made at the end of period 1. That's 1 period in the future. Now, in order to come up with its present value, we have to come back to period 0. So Marlon, this is exactly the question that I had asked you. Why did that first payment not end up as $100? Well, because it's at the end of period 1, we need to discount it back 1 period. All right, so that $100 is actually only worth $95.24 today. Period 2, it's going to have 2 periods that it gets adjusted. So it's going to have a reduced value of down to $90.70. The third one needs to be discounted for 3 periods. It's only worth $86.38 for a total of $272.32. Let's the Excel spreadsheet process. Financial functions. We're looking for the present value, not the future value. Let's run down here, the present value. Rate, 5% again. Number of periods, 3. Payment, still a negative 100. Future value, we don't know the future value. I guess we did, but we wouldn't ordinarily. Type, this is an ordinary annuity, not an annuity due, so we leave that blank. Hit OK. $272.32. It came back perfectly with what the book says we should have found. Present value of an annuity due. Figure not in textbook. How cool. So you got to use the toolkit in order to actually see this. Now, this is not one of those things where remember we had the one freebie in the annuity, ordinary annuity when we were doing future value. We're going to get a freebie here in the annuity due because why? Because we're looking for the value of this money at period 0. And our first payment is made at period 0. So it's going to be worth $100. There's no adjustment because we just made the payment. What's it worth? Well, it's $100. The payment that's going to be made at the end of period 1 will be discounted back 1 period, so 95.24. The third payment made at the end of period 2 is only going to be adjusted for 2 periods, so that's $90.70. Total value of $285.94. Present value is what we're going to be using. Find the financial. Present value. The rate, 5% still. Number of periods, 3 periods still. Payment, -100. We don't know the future value. The type, since this is an annuity due, we have to put the 1 in. Hit OK, $285.94. Perfect. Really like Excel for these purposes. And once again, they keep pointing it out in the electronic version here. Hey, you might want to skip over to chapter 4, the toolkit, because they didn't put it in the text for you. Finding annuity payments, periods, or interest rates. So there's 5 variables that are involved. N is the number of periods, I is the interest rate, PMT is the payments, FV is future value, and PV is present value. If you know any 4, you can find the 5th by solving equation 4.2 for ordinary annuities. For annuities due, equation, blah, blah, blah. However, a trial and error procedure is generally required to find N or I. Variable annuities. Retirees appreciate stable, predictable income, so they often buy annuities. Insurance companies have been traditional suppliers, using the payments they receive to buy high-grade bonds whose interest is then used to make the promised payments. Such annuities were quite safe and stable and provided returns of around 7.5%. However, returns on stocks, dividends, and capital gains have historically exceeded bonds returns. Therefore, some insurance companies in the 1990s began to offer variable annuities, which were backed by stocks instead of bonds. The insurance companies that pioneered variable annuity, the Hartford Financial Service Group, tried to hedge its position with derivatives that paid off if stocks went down. But like so many other derivative-based risk management programs, this one went awry in 2008, because everything went to hell in 2008. Because stock losses exceeded the assumed worst case scenarios. U.S. insurance companies at the beginning of 2008 saw their stock prices fall from $85 to $4 because of the general stock market crash. Investors feared that Hartford would be unable to make good on its variable annuities. So understand, we do have this thing out there called variable annuities, but there's a certain amount of risk in it. All right, finding annuity payment, PMT. We need to accumulate $100,000 and have it available 5 years from now. We can earn 6% on our money. We know that the future value is going to be $10,000. Our present value is 0. The number of periods is 5, and the interest rate is 6. We can enter these values in a financial calculator, or I'm pretty sure we can do it over here in Excel. So let's bring up Excel. Oops, missed. And see what we can do. All right. So 5 years, 6%, present value 0, future value of 100. So if we do payments, PMT, okay, rate, 6%. Number of periods, 5. Present value, we know that the present value is 0. The future value that we want to get to is 10,000. Type, I don't think we need to put the 1 in there. Oh, we can. End mode and begin mode. If we want to do it at the end, it would be the equivalent of an ordinary annuity. So let's leave it 0. Hit OK. 1,488.02. What did I do wrong?
I think the thing has you have the equals PV in there still in the like the
Oh, I
bar.
gotta clear that out. Yeah, let's do that. Let's clear that out and start over. All right, so payment. Rate of 6. Number of periods 5. Present value 0. Future value of 10,000. Type 0. 177396. Thank you for seeing that. Let's do it again, but this time as the beginning of the period, so there will just be the equivalent of an annuity due. Rate of 6. Periods 5. Present value 0. Future value 10,000. Type 1. 1673.55. So if you needed to make sure that you accumulated $10,000 5 years in the future and you knew you could get 6%, if you were able to make the payments starting now, if you made 5 payments of $1,673.55, you'd have that $10,000 in 5 years. If you couldn't make the payment till the end of the first period, then you would have to put away $1,773.96. The difference, of course, is the compounding that you would see for that extra period, because this payment is made at 0.0, this payment is made at 0.1. All right. So if we were looking for the number of periods, suppose you decide to make your year-end deposits, but you can only put $1,200 a year, assume you would earn 6%. How long would it take you to receive your $10,000? So this is going to be number of periods. Rate, 6%. Payment, we're going to make $1,200 a month payments or year payments. Present value is going to be 0 because we don't have anything to start with. Future value, $10,000. Once again, if we leave it 0, that means we're doing it at the end of the period. 6.958, so 6.96. So we would need almost 7% to make that work. Once again, if we were going to do it as an annuity do everything at the beginning of a period as opposed to at the end of the period. Rate is 6%. Payment is $1,200. Present value is still 0. Future value, we need to get to the $10,000. This would be type 1. 6.63%. So we would have to look around and see if we could get that value as far as our interest factor. Finding the number of periods. We did interest factor. Number of periods. They don't give it to us over here. Finding N. Oh, here it is. Okay. So bring up the handy dandy. It's going to be an N per that we're looking for. Rate is still 6%, I'm assuming. Payment is going to be the 1,200, I guess. Present value is still 0. Future value, still want to get to 10,000. Type is going to be 0. So 6.96. Oh, that's years. 663. I guess I did the same thing twice here. Suppose you can only save 1,200 annually, but you still want to have the 10,000 in 5 years. What rate of return? Oh, I did it backwards. Okay. So this one would be rate. Let's change that to rate. What did I do wrong? Rate. Number of periods, 5. Payment, 1,200. Present value, 0. Future value, $10,000. Type 0 if we're not doing anything in advance. So 26%, we could expand that out. Let's do it just because, I don't know. If we do the same thing. Ah. Rate, number of periods, 5. Payment, 1,200. Present value, 0. Future value, 10,000. Type 1, because we're doing that at the beginning. Okay. I didn't take that out of there. I should have done it. Let's do it this way. Nice try, John. Nice try. Should always be empty before you start, right? Do it one more time. Sorry I'm boring you guys, but every now and then I have to get it right. Rate. Periods 5. Payment 1,200. Present value 0. Future value 10,000. Type 1. Okay. 17.54. So as you can see, we can calculate any of those things. Let's get a little more complicated. All right, what happens if we don't have an annuity? We have an uneven or irregular cash flow. Many financial decisions do involve constant payments. Many other involve cash flows that differ from year to year. These are uneven cash flow streams or irregular cash flows. If you're going to make new product, expand production capacity, replace machinery, it's always going to generate cash flows, excuse me, that vary from year to year. We use the term payment in situations where the cash flows are constant and thus an annuity is involved. If different cash flows occur in different time periods, then we use the term CF, cash flow in period T. So payments, PMT, is always going to refer to an annuity where the payments are equal. CF, or cash flow, means that the amounts can change from period to period. Two important classes of uneven cash flow. First, those in which the cash flow stream consists of a series of annuity payments plus an additional lump sum in year N, and all other uneven streams. So let's take a look at stream 1, annuity plus an additional final payment. So we have our timeline from 0 to 5. We have a $100 payment at the end of years 1, 2, 3, 4, and 5. And then at the end of year 5, we also have a $1,000 payment. So in year 5, we get $1,100. This is also telling us that our interest factor is 12%. Now, what does this look like to you? Anybody? What does this actually look like? In the business world, what does this look like? This is a bond. This is a $1,000 bond that you're getting 10% on. So every year you're getting $100. That's your 10% interest. And it's a 5-year bond, which means at the end of the 5th year, you get your $1,000 back. So you get, you paid $1,000 at some point, but now you're going to get your $1,000 plus 5 $100 interest payments. That's what that looks like. All right. Now let's look at stream 2, which is just irregular cash flows, where we're going to have 100, 300, 300, 300, and 500. Now, what does this look like? This isn't a bond, because the bond would have a number that was repeating, but then it would have a larger payment at the end of the period. This is just something that has different numbers in it. So let's say that you have the opportunity to invest $1,000 in a new machine in your factory. And you talked to the people in the production department, and you say, okay, so if I give you the $1,000 to buy this new machine, what am I going to get for this? What am I going to get back? Well, what's going to happen is it will reduce our costs because we're going to become a lot more efficient. So it will increase our profits on a yearly basis. Year 1, we're just going to be getting used to the new machine. So although we will have some reduction in costs, we're only going to make an extra $100. But in year 2, 3, and 4, we're going to have $300 in savings. So we'll have increased profits of $300 in each of those 3 years. And in year 5, which is going to be the last year that we're going to have any benefit from buying this new machine, we'll end up having $500 worth of savings, which of course translates into $500 additional profit. So if I were to pay $1,000, I would be getting back 5, 8, 11, 14. I'd be getting back $1,500. Is this worth doing? That's what you have to ask yourself. Is this worth doing? And you need to figure out whether it's a good investment or a bad investment. Okay, so to find the present value, you could use a step-by-step process and then just come up with the present value of each of these as you take it back to year 0. So 1 period, 2 periods, 3 periods, 4 periods, 5 periods. Same thing here, and you'd get good numbers doing that, and that's fine. And here's a way to do it on your financial calculator. In Excel, use the PV function. So what you would end up doing, okay, so this is this one up here where we have the 100, 100, 100, 100, and then the 1,000, okay? So yes, we could use the present value function, and well, let's do it to show how we can value a bond quickly and easily. All right, so we're going to use the present value function right here. Okay, what's our rate? We know we have a 12% rate. The number of periods is going to be 5. Payment, is going to be $100. Guess should I make that a negative? Let's leave it positive, just see how that works out. The future value is going to be that additional $1,000 that we receive. So we'll take that $1,000 and type 0 because it's not an annuity of due. So we come up with a value of $927.90. It's a negative number because that's what it would cost us to buy this right now. Now, I knew before I started this problem that it was going to come out to be less than $1,000. Like I said, this looks like a bond that we bought, a $1,000 bond that was a 10% 5-year $1,000 bond. But since we know that we're in an environment where the market rate is 12%, our 10% bond isn't going to be worth the full $1,000. So if we wanted to buy it, we would be able to get it at a discount because it's only paying 10%, whereas the market is paying 12. So we could have this $1,000 bond for $927.90. That worked out pretty well. Okay. So yes, that worked out nicely. What about this one here? Okay, this one here where we have the individual numbers changing on a yearly basis, 100, 300, 300, 300, 500. If we did the step-by-step basis, we would just do the present value of each of the years. This would be $80, this would be $200, this would be 200, this would be 190, this would be 280, and then add them all together, it would be worth $1,016.35. Financial calculator would give us that also. How do we do it in the Excel spreadsheet? Well, our function is going to be NPV, probably net present value, I think. So let's see if we can recreate that on our spreadsheet. All right, so we're going to end up with net present value of cash flows, financial, for the NPV, returns a net present value of an investment based on a discount rate and a series of future payments, negative values, and income positive values. So let's hit our net present value. The rate we know is 12%. That was given to us on the timeline. We might have a big zero there. Value 1. So what we're going to end up doing is putting in all of the values. So value 1 is $100. I'm wondering if these should be negatives. Value 2 is $300. Value 3 is $300. Value 4 is $300. Whoops, I got to get a value 5. What did I do wrong? Let's start over. NPV, do that again, 12%. Value 1 is 100. Value 2 is 300. Value 3 is 300. Value 4 is 300. How do I get another number? Oh, here we go. Guess I went a little farther. Value 5 is 500. Hit OK. 1016.35. All right, so if you had this stream of income coming back to you and you were given an opportunity to spend $1,000 today, would it be worth doing this investment? Well, you'd get 1,016 back present value. You're getting $1,500 back in total, but we're looking at the present value of that stream of money. So you would really be getting $1,016 measured in today dollars. Okay, so that makes perfect sense. I guess you would do it unless you wanted to have a much larger rate of return when you do this, but whatevs. All right, getting rid of this again. Future value of an uneven cash flow stream. Okay, an irregular count. Panel A shows a basic timeline. It contains the inputs, and first use a step-by-step approach to find present value of 1016. All right, we already did this. Uneven. Let's move forward. All right, so what's our issue here? We have 100, 300, 300, 500. Oh, so we're doing the future value, not the present value. Okay, so that makes sense. We're doing the future value now. So what are all these things going to be worth in the future if we receive these amounts? Once again, the purpose of this could be that you need to fund something, or you want to know what this is actually going to be worth if you put all the money aside that you made from this. So it's going to be future value. So it's going to be, we have to find the net present value, and then we have to do compound the net present value to find the net future value. Okay. That's easy. No, it's a two-step process. So we absolutely love two-step processes, don't you? I know I do. Let's do it. So we already know that our present value is 1016.35. So they've already showed us this right here. So now what we want to do is we want to compound that into the future. So it's going to be future value. Okay, the rate, I believe, is still 12%, yes. The number of periods is going to be 5. The payment, we're not doing payments, we're just taking a present value and taking it into the future. The present value is going to be the 1016.35. And type 0. 179116. They gave us 15. So I rounded something somewhere. So the future value of this stream of uneven payments is 1791.15 or 1791.16. Okay. What's the future value of this cash flow stream? 100 at the end of year 1, 150 at the end of year 2, 300 after year 3, assuming appropriate interest rate is 15%. So it's basically the same problem we have here. Future value of, what do we have? 3 years, right? 15%, 100, 150, and 300. So let's do it. Pull it to this side so we can see it easier. So what did we do? We did the net present value, the NPV first. Rate is 15%. Value 1 is 100. Value 2 is 150. Value 3 is 300. So the present value is 397.63. If we did the future value, then that would be, the rate is 15% still. Number of periods would be 3. Payment, no, because it's not an annuity. Present value is 397.63. And type 0, 604.75. Okay, it does work. All right, solving for interest with an irregular cash flow. For spreadsheets, it was extremely difficult to find I if the cash flows were uneven. However, with spreadsheets and financial calculators, it's easy to find I. If you have an annuity plus a final lump sum, you can input values for N, PV, PMT, and FV into the calculators. Uneven cash flow stream, IRR, the internal rate of return. All right, so what do we have? We have a payment out of $927.90, and then we have a return of 100, 100, 100, 100, and 1100. Okay, so this was that, if we go back, that was when we did the fair market value, or the present value of this stream of income right here, and came up with 927.90. Which is the reverse of this. So finding the interest rate, the annuity plus lump sum. So we know, let's do it, the IRR. Financial, IRR, values. And I guess, values in an array are reference to cells that contain numbers for which you want to calculate the internal rate of return. Okay, so what we want to do, I guess I have to have a, let's cancel this. So I need to have the amounts here. So negative 927.90, 100, 100, 100, 100, and 1100. All right. Let's try that again. So I have to have it on a chart like that. Okay, values are going to be, can I move this? Yeah. H21 colon H26. I could take a guess. I don't think I have to, though. All right. It told us it was a 12% internal rate of return. We could also do rate, but then what would we be doing? G, B, B, B. So we'd be doing G 31, the number of periods. B528, B528 would be the $100 annuity payments. B532 is the amount that we paid. B529 is the $1,000 lump sum. So we could do that if you want. Let's do rate. All right. Number of periods is 5. Payment is going to be the 100. Present value, I think, is 0. Future value is going to be the 1,000. Type is going to be 0. I did something wrong. Maybe. Oh, well, we'll worry about it another time. All right, we did get it with the IRR, so I'm okay with that for the moment. All right. And then what happens to this other one where we paid out the $1,000 and then we got the 5 years worth of irregular returns? We can do the IRR. Basically, it's the same thing where we have to have the amounts in an array so that we can pick them up. Let's go back and do that. So for this one, we're going to end up with the negative 1,000, the 100, the 300, the 300, 300 again, and then 500. And then if we do the IRR, values are going to be H31 colon H36. I'm not going to guess. 13%. I guess if we change that, whoa, wrong one. We get hit to 12.55. So we have our rate of return there. Ah. I'm going to stop share for a minute. I'm sure I've lost most of you. If anybody is still awake, though I guess the one thing that I want to point out is that the way that I look at everything that we're doing in this course, I believe that Excel is the answer to all of our problems. We can find all of the answers to the questions that we might ask by using Excel. We might end up having to set up some charts. We may end up having to put arrays of information in, but it does have the ability to do that. What I'm going to suggest to you, and this is how the first time that I taught it, that I did it so that I was able to keep track of everything, I started creating a massive master, if you will, master spreadsheet with all of the various answers, the various things that we're trying to do. So I made a little narrative on the spreadsheet of what this particular question was. You know, what was I trying to find? And then I would put the example from the book on the spreadsheet. And then I just kept building that master spreadsheet as I went through the semester. Because when we get to the point where I'm going to give you the first exam and the final exam in this course, it's going to be pretty much everything you're looking at right now. It's going to be a lot of questions that are asking you to find different things. And it's going to be open book, it's going to be open computer. And realistically, if you have gone through and created this master spreadsheet for yourself, it will be your cheat sheet. So basically your ability to get, so for example, if you wanted to label it as, solving for interest with irregular cash flows, and you could put that as your description as to what you're doing there, and then put out there the calculation, the function, and whatever chart that you might need in order to do that. It will make your life easier when we get to the exams. Any questions? Anybody, still awake that wants to ask a question out there?
I have a question.
Sure.
So for our homework for chapter 4,
Yeah.
I know you said it's usually due the day after class at midnight. Is the chapter 4 one due tomorrow, like Wednesday night at midnight? Or
I
do you
don't
want to do
I
it
don't think
Friday?
so. Yeah, I think because I believed that we would be running, and we're going to run, because I don't want to do a whole heck of a lot more of this. So to be honest with you, because it's starting to get to me right now. I believe it's due Friday midnight.
Okay. All right. Thank you.
I could double check that, but I believe I set it for Friday midnight.
Okay. Thanks.
Anybody else? Anybody else want to do more, or you think you've had enough of this for the moment? And let me see, how far are we in this darn chapter? How much is left? Make sure we can finish it on Friday. Yeah. You want to go a little bit further, or you want to call it a night right now? Take a vote.
I vote call it a night.
I'm with Jordan on this one.
I agree.
Okay.
Agreed.
Everybody feels that's enough. All right. Yeah, that was a lot. This is one of those chapters that's extremely long and extremely boring. We're learning how to do the various things, and we saw examples as to why we're doing them. Keep in mind that this is a business course, and we're not just doing these exercises for the sake of trying to come up with some sort of, pretty number that we can look at. Each of these functions has a legitimate purpose in the business world. So like I said, if you really look at what we were just doing with these irregular cash flows, I'll share my screen again just for a second. Taking a look over here at figure 4.9, that's a legitimate business decision. Okay, if we were to take $1,000 and invest it into something, and it doesn't have to be $1,000, it could be $1 million, it could be $100,000. What kind of a return are we going to get back? And it's not good enough for us to look at these 5 amounts that we're going to be getting and say, well, we're getting $1,500 back for our $1,000 investment. That's obviously good enough. It may not be. If we were to move these numbers around a little bit. So for example, we see that our first amount back is the lowest amount, and the last amount back is the highest. So with what we're learning in this chapter with regard to present value, we want to compare this $1,000 outlay of cash versus this future return of money. This $500 out here, if we were to do the present value of this $500, what's the percentage here? Call 12.55. Let's just do it just for the heck of it. Present value. So if we were going to take at 0.1255, number of periods 5, payment, no payment, future value is 500, no type. That $500 in the future is only worth $276.85. So when we're comparing it to this $1,000 outlay, this $500 being so far in the future made it worth only about half, a little better than half of the number, the absolute number. So when we're doing this comparison, even though we have $1,500 coming back, it may not have been an automatic, oh yeah, that's a good investment. Let's go ahead and do it. Let's say that we had 0 return for year 1, and then $100 return for year 2, and then still keep it at $1,500, whatever we need 3 and 4 to be, but pushing the return further out in the future makes it less desirable. Now, if this was reversed, if it was, we would immediately get our biggest return of $500 in year 1, then these 300s, and then it starts tapering off. So in year 5, we only got the 100. The value here would be significantly greater than what we calculated because the big number became earlier. So we didn't have to discount it as much because it was 5 years in the future. If that was 1 year in the future, that $500 would be worth something like $470 or something to that effect. Well, let's do it. I already set it up. So present value, $500, 12.5% again. Number of periods 1. So if it's at the end of period 1, no payment, future value is 500, and calculate it. Yeah, it would be worth $444. And so this $1,000 outlay would be worth significantly more than the 1,016 that we calculated, up here. The present value would be much, much higher if the money came to us earlier. So this particular investment here was not a given. It came very close to not being profitable at all. So if this would have come back at less than $1,000, then what we would have said is it's not worth us paying $1,000 for a stream of income that's going to have a present value of less than what we're spending today. We would never make that decision. Right now, I don't know that I want to make $1,000 investment to make $16 over 5 years. I don't know. What your company is going to have its own standards as far as what type of return it demands before it decides to make an investment. That $16 may not have been enough. So, these are all legitimate business tools that we're talking about. Stop sharing again. These are all legitimate business tools that we're all dealing with. Let me get rid of this off of my screen. I do want to take attendance. I'm going to do it the simple way. I'm just going to call out your names. I'm not going to bother looking for your names because I have to shrink this down. Okay, I can't do that, but I can do, I guess I can do this. No, let's see, what can I do? All right, so let me get back. Here we go. You guys are still there, right? Attendance. I gotta log back in, sorry. All right, 5:44, session. And all righty, Ryan. Ryan was
Present.
all right. There you are, Thaddeus. Didn't show, eh? Manuel Bowden. No. Libby, I saw you were there. Marlon.
Yeah.
Yep, Marlon was there. Kayam was there. Jacob France is there. Alec, I know, was behind Chase. Jordan is there. First vote to terminate. Chase was there. Mackenzie, I know where she is. Jackson, you were there, right?
Yep, I'm here.
Donnell, I didn't see Donnell. Was Donnell around? No. Mez, you're there. Jacob Troutman and Anthony Trobeck. All right,
Yeah,
great.
I'm here.
Yep, I saw you. All right, that's let me just get back to where I was so I can take a look. Yeah. Okay, any questions for anybody? Thursday is going to be online just like this. We will finish chapter 4, begin chapter 5. As I said, the homework will be due Friday instead of tomorrow because we didn't finish the chapter. That would be silly for me to expect you to do the homework before we finish the chapter. Libby, I will take care of that issue for you as soon as I get an opportunity, so watch for it.
Thank you.
No problem. Sorry about your grandfather, by the way. It's a terrible thing.
Oh, I appreciate it. Thank you.
I didn't realize it much until I became a grandfather, and I realized how much that I like my grandkids, and I hope they like me as much as I like them. But that's, never a good thing to lose someone that loves you. All right, let's call it a night, and I will see you guys on Thursday, 6 o'clock on Zoom. I will send you another link because I just set this one up for tonight. So I'll set up another Zoom invitation. You'll get it through the email. And if anybody has a question, just email me. And otherwise, we'll finish up chapter 4 on Thursday, and off we go.
All right. Have a great day.
Thanks. You guys have a good day too.